Welcome to Smart with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android.
Super handy.
The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saves screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets.
That's a lot of data.
It really is. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list and comes down to about $14.93 per month when billed annually after the discount.
Right, great deal.
Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So getting right into it, right now there's this massive, just overarching narrative that is fundamentally rewiring global markets, and it operates entirely in the background of our daily lives.
Yeah, completely in the background. Most people don't even see it.
Exactly. It all centers around critical minerals. I mean, we are talking about a silent trade war where the stakes literally couldn't be higher.
It really comes down to one undeniable geopolitical reality, which is China's export controls. For decades, the Western world effectively outsourced this incredibly complex and honestly pretty messy job of processing critical minerals to China.
Because it was cheaper and it kept the environmental headaches off Western soil.
Right. But now that reliance is being weaponized. We are watching a forced, an incredibly urgent rebuild of the entire Western supply chain for critical materials. And when you survey the board, energy fuels isn't just another mining play.
No, definitely not.
It's actively positioning itself as the literal geopolitical linchpin of this whole supply chain reconstruction.
I want to unpack this carefully, though, because the macro tailwinds you're describing are undeniably massive. But as investors, we have to look at this through a highly practical, risk-aware lens. Yeah. Because it's one thing to have a fantastic geopolitical narrative, but it's an entirely different thing to execute on it efficiently. So the core question for you listening is this company fundamentally equipped to capitalize on this kind of AI-style momentum? Or are the capital-intensive realities of development just too risky to justify the current valuation?
All right, let's move into the wealth-building context.
Because translating a geopolitical crisis into actual shareholder return is, well, that's where the rubber meets the road.
Exactly. To understand why energy fuels matters for long-term portfolio growth in this deep dive, you really have to look at the massive structural transformation they're undergoing right now. Yeah. They're pivoting away from being just a traditional, cyclical uranium and vanadium miner. They are actively transforming into a vertically integrated critical minerals processor.
Which is huge.
It's a total evolution of their business model, moving from simply pulling rocks out of the ground to processing the most highly sought-after elements on the planet.
And that's exactly where my analytical skepticism kicks in a bit. Because let's look at the cash flows. They currently pay absolutely no dividend.
True.
Instead, they're choosing to take 100% of their cash flows and just reinvest them straight into this critical mineral infrastructure. To put it in perspective for you listening, it's like buying the only toll bridge in town, which sounds great on paper.
Right.
But right now, we are the ones paying for the concrete, the steel, the labor. So how long do long-term investors have to wait for the actual toll revenue to kick in?
I completely understand the hesitation there.
Yeah.
When you don't see an immediate yield or a massive stock buyback program, it's tough. But this infrastructure investment, the concrete, as you call it, is exactly what creates a structural, multi-year wealth-building opportunity.
Do you think so?
Oh, absolutely. Because if they were just paying out cash right now, they would remain a simple mining stock tied entirely to those boom and bust cycles of raw commodities. By aggressively reinvesting into processing infrastructure, they're building a fundamentally new, much higher margin business.
Processing is where the real pricing power lives.
Exactly. This isn't a short-term trading setup. It's a foundational growth play designed to capture a permanent shift in global supply lines.
Now let's look at the fundamentals.
Because if we are building this proverbial toll bridge, we need to understand exactly how wide the moat is around it. And I can tell you, the moat here is extraordinarily aggressive.
Yeah, it's pretty wild.
Their primary competitive advantage centers around one specific asset, which is the White Mesa Mill in Utah. And this isn't just a piece of heavy equipment, it is an irreplaceable regulatory and physical fortress.
Right. It's the only fully licensed and operating conventional uranium mill in the United States.
But here is where the story gets really fascinating. It is the only facility in the entire Western Hemisphere right now that is capable of processing monazite sand into separated neodymium-praseodymium, commonly known as NdPr.
Let's clarify what that actually means for you listening, because NdPr isn't exactly a household dinner conversation.
No, definitely not.
Neodymium and praseodymium are crucial rare earth elements used to manufacture high-strength permanent magnets. And these aren't your typical refrigerator magnets.
Right, far from it.
These are specialized magnets that don't lose their magnetic fields at extreme temperatures. So they're the absolute beating heart of electric vehicle motors spinning at 15,000 RPMs, wind turbine generators, and advanced defense systems like the F-35 fighter jet.
You literally cannot build a modern green economy or a modern military without them.
Right.
And obtaining the licensing to build a new conventional mill capable of processing these radioactive sands in the U.S. takes well over a decade. It's not just a matter of cutting through red tape, you know?
Oh, getting a permit for a facility like this today is like trying to get zoning approval to build a massive new international airport in the dead center of Manhattan.
That's a perfect analogy. The environmental impact studies, the complex water rights, local zoning laws, the hurdles are so vast that existing facilities essentially operate outside the normal laws of competition. So by already having White Mesa fully operational and licensed, Energy Fuels effectively possesses a temporary monopoly. They can step right in and capture the market share being directly displaced by those Chinese export controls.
I do want to dig into the Q1 2026 earnings numbers, though, because the market reaction requires some serious nuance here. They actually posted a revenue beat, which is great.
Definitely.
And that was driven by accelerating uranium demand and robust long-term contract prices sitting well above the current spot price. But they had an earnings miss.
They did.
And when you're touting a monopoly, an earnings miss raises immediate red flags. However, when we dig into the mechanics of why they missed, it paints a slightly different picture.
It really does. Because the miss was driven almost entirely by temporary operational costs. Ramping up these new rare earth element separation circuits is incredibly expensive.
Oh, extremely.
You're calibrating highly specialized equipment, you're paying elite engineers around the clock, all before a single ounce of commercial product even goes out the door.
And let's talk about how they're actually paying for those operational costs, because their financial health is stellar. I'd go so far as to call it a fortress balance sheet, which is incredibly rare for a development stage critical minerals company.
Usually they're bleeding cash. Right.
Bleeding cash and buried in debt.
Yeah.
But Energy Fuels is sitting on over $100 million in working capital, and crucially, they have zero long-term debt.
Which is massive.
Now, it is true that their free cash flow is currently neutral to slightly negative because of the heavy capital expenditures required for these rare earth circuits. But that massive cash pile shields them from the toxic financing dilution, meaning issuing endless new shares that constantly plagues their peers.
Right.
And mathematically, that cash flow is expected to turn decisively positive in the back half of 2026 once the rare earth commercial sales actually start hitting the books.
And when those sales do hit, the forward margins are projected to be spectacular. As their monazite processing volumes increase, all those heavy fixed costs we just talked about get absorbed over a much larger production base.
Right, economies of scale.
Exactly. And that leads directly to significant gross margin expansion. They go from paying for the infrastructure to purely collecting the toll.
That brings us to the catalyst timeline.
Yeah. What are the exact milestones we're watching to prove this grand geopolitical thesis is actually playing out on the balance sheet?
Well, over the next 3 months, the major event is going to be the Q2 2026 earnings, dropping in early August. Consensus is going to be hyper-focused on one metric above all else, which is the actual volume of monazite processed.
The narrative has to transition into tangible volume at this point.
Exactly. And investors also want to see if any new long-term uranium contracts were signed, while global spot rates remain elevated.
Aside from earnings, the continuous sort of rolling catalyst is the macro environment itself. We're seeing escalating U.S.-China trade restrictions, specifically targeting critical minerals like antimony, gallium, and of course, rare earths.
Yeah, it's nonstop.
Every single time a new export restriction is announced out of Beijing, the intrinsic replacement value of the White Mesa mill inherently goes up. It just becomes more critical to national security.
There's also a hidden catalyst here that I don't think is getting nearly enough attention from the broader market, and that's the Federal Reserve.
Oh, interesting point.
Yeah, potential rate cuts act as a massive, under-the-radar tailwind. Think about the fundamental math of a capital-intensive developer. Lower interest rates decrease the discount rate used by analysts to value long-duration capital projects.
So the future cash flows are worth more today.
Precisely. The future cash flows from that massive rare earth circuit suddenly become significantly more valuable in today's dollars. It changes the entire valuation model.
That's a vital point on the macro mechanics. There's also a persistent, highly speculative rumor floating around the industry right now that we really have to acknowledge.
The government grants.
Yeah. There is constant chatter regarding potential Department of Defense or Department of Energy grants. These would be specifically aimed at expanding heavy rare earth separation at White Mesa.
Which makes total sense given the company's existing, deeply entrenched relationships with the Pentagon through their tungsten and uranium operations.
Right. A dedicated government grant announcement is viewed by many institutional watchers as a highly probable near-term catalyst. It would essentially be the U.S. government directly subsidizing the completion of that toll bridge.
Now let's pivot to the chart.
Because we need to see how all of this fundamental and macro data is actually translating into price action.
We're currently seeing what technicians call a repricing breakout. The stock is clearing multiple prior resistance levels. For years, those resistance levels were strictly associated with its old, legacy, uranium-only valuation.
Just a pure minor.
Right. But what the chart is showing us right now is the psychological process of the broader market attempting to reprice the stock for a dual commodity revenue model, uranium plus rare earths.
Yeah.
It just warrants a completely different, much higher valuation multiplier.
And the momentum context backing that breakout up is incredibly strong. The stock is experiencing high relative strength compared to the broader market. It's being described by some analysts as having AI-style momentum.
Which sounds like hype, but there's weight to it.
Exactly. I want to emphasize to you listening, this volume inflow isn't just fleeting retail speculation on a message board. This is being driven by heavy thematic capital rotation.
Big money moving.
Yeah, we are seeing structural, institutional money physically reallocating into critical minerals to front-run the supply chain shift.
So what does market sentiment look like?
Are the major institutions actually buying the story, or are they just watching from the sidelines? By and large, the overall market mood is overwhelmingly bullish.
For sure.
The smart money is happily looking right past that Q1 earnings miss because they are entirely focused on the much larger structural geopolitical deficit in critical minerals.
Yeah, they see the bigger picture.
We saw a major analyst move recently that perfectly encapsulates this sentiment. On May 8th, 2026, H.C. Wainwright maintained their buy rating and explicitly raised their price target from $27.25 to $29.
That's a massive signal of strong institutional validation, especially in the face of an earnings miss. Seeking Alpha also recently upgraded the stock to a cautious buy.
Exactly.
I always like to look at the underlying flows, though, because that tells you what people are actually doing with their money, not just what they're saying in research notes.
Yeah.
Interestingly, we haven't seen aggressive insider cluster buying over the last 30 days.
Which usually raises an eyebrow, right?
It can, yeah. But after a significant price run-up like this stock has seen, insiders often pause their buying to avoid the appearance of trying to time the top. However, when we look at the 13F filings, which show us what the big funds are holding, we see a rapidly growing institutional footprint.
They're loading up.
Oh yeah. ESG-focused funds and critical mineral thematic ETFs are actively accumulating shares. They are practically forced to allocate capital to Western NdPr production to meet their own internal mandates. And right now, Energy Fuels is virtually the only game in town.
Now let's talk about the risks.
Because absolutely no industrial transition of this magnitude happens without serious potential pitfalls, and we have to protect our downside. The first major risk is commodity price weakness. specifically exposure to spot prices.
Right.
For example, China's spot vanadium pentoxide prices were slightly lower last month. If global uranium spot prices were to suddenly collapse alongside vanadium, their legacy revenue streams would face severe margin compression. It is the classic unavoidable risk of being a commodity producer. You are at the mercy of the global price.
It is a fundamental risk, but this is exactly where their fortress balance sheet offers a highly unique mitigation strategy.
Because of the debt.
Right. Because they have zero long-term debt, they have incredible operational flexibility. If vanadium prices drop below the actual cost of production, they don't have to keep mining it at a loss just to service crushing debt payments.
They can just pause.
Exactly. They can simply curtail vanadium production, place that specific part of the mill on standby, and focus solely on the high-margin rare earths and their heavily contracted uranium. That is a luxury of survival that their highly leveraged, debt-burdened peers simply do not have.
That's a fair point on the debt. But the second risk is entirely internal, and it's what keeps me up at night regarding this play, which is execution and scaling risk.
Okay, yeah.
That Q1 earnings miss is tangible mathematical proof of how incredibly complex it is to scale a first-of-its-kind rare earth separation circuit in the United States. I mean, there are so many engineering variables.
It's not easy.
No. If they experience significant cascading delays in hitting their nameplate capacity for NdPr, it could severely damage the entire bullish repricing thesis we just laid out.
I will push back on the severity of that engineering risk slightly. The complexity is absolutely real, but we have to remember that Energy Fuels isn't trying to invent brand new science here in a laboratory.
Right, it's existing tech.
Yeah, the process they are using is called solvent extraction. To visualize this, imagine a massive vat of water with a single drop of blue ink mixed into it. Solvent extraction is like using highly calibrated chemical magnets to pull just the blue pigment molecules out, leaving the water perfectly untouched. It's an incredibly delicate molecular wash.
And getting that wash wrong is very expensive.
True, but this exact off-the-shelf solvent extraction technology is already widely deployed and highly optimized in China. The underlying chemistry is entirely proven. Energy Fuels is simply adapting that existing blueprint for the White Mesa facility.
So it's more about integration.
Exactly. So while Q1 looked like a miss on paper, it was really a timing issue regarding capital outflow versus revenue inflow as they dialed in the calibration. It was not a fundamental technological failure of the separation process itself.
So with everything on the table, what's the final verdict?
Looking at the totality of the data in this deep dive, from the geopolitical tailwinds to the balance sheet, the official investment rating here is a bullish score of 8 out of 10.
Pretty solid.
Yeah, for you listening, the elevator pitch boils down to this. Energy Fuels is the premier pure play on Western rare earth independence. They possess a debt-free balance sheet, a recently raised $29 price target from institutional analysts, and an impenetrable physical moat, the White Mesa Mill, that would take any competitor a full decade to replicate from scratch.
From an analytical standpoint, the investment horizon here aligns strictly with a multi-year time frame. This is a multi-year hold.
Yes, absolutely.
The full financial value of this rare earth separation ramp-up, combined with the U.S. government's aggressive onshoring mandates, it's going to take roughly 2 to 3 years to fully mature and reflect cleanly in the bottom line. It requires patient capital to capture this structural repricing.
Exactly. It's about looking at the broader picture.
And as we watch Energy Fuels attempt to physically rebuild the supply chain, it really leaves you with a much larger economic question to mull over.
Oh, for sure.
If the West is truly forced to fully decouple from China's cheap, heavily subsidized rare earth ecosystem, are we as consumers actually prepared for the sudden massive inflation in the cost of our electric vehicles, our smartphones, and just our everyday technology that will inevitably follow? I mean, independence has a price tag.
It certainly does.
If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount.
That's a good tool.
It is. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.